In Chapter 12, we're going to continue our discussion about equity, stock, and then a couple of other issues. So one of the things that we're going to talk about is that companies try to make sure that they can repeat information. So if their financial statements can't be used to predict future results, then we have, what are the point of financial statements? So we want the stuff that's in our regular financial statements to be the normal recurring activities that our business has. So therefore, when things that happen that aren't part of our normal everyday business, we record them in a different way. They get special treatment. So these two items, one are non-recurring items that are unusual and or infrequent. So they can happen, but it's rare for them to happen. And then the second thing that we're going to record separately are if we discontinue operations for any purpose. So this can even be that we closed one location of a business. So it was a merchandising business and we decided to close one store. Then we would report the information about that store separately, and we would say that they're not going to affect our further financial statements. Here's an example from your textbook of, sorry about that, I was interrupted by children and dogs. As I was saying, we have this example from your textbook of a company that operates retail stores and 2 motels. So during the year, they decided to sell the 2 motels and just focus on our retail business. They also have an unusual and infrequent item. So they lost money in the settlement of a lawsuit. When we have this example, we have information from the discontinued operations is below on the income statement. It's separated from our income from continuing operations to show that there's information that is part of our income statement, but we don't expect that to recur every year. We also have the $120,000 loss on settlement of the lawsuit. That is an expense, and we have it posted on there. We want to state that it was because of an event. We might also note in our notes to the income statement that that was an infrequent event that we do not expect to recur again. So when we have discontinued operations, we have to show that segment's operations separately in the income statement because, as I said before, that is not going to be a recurring part of our company's operations. So we don't want outside investors or banks or anything to be judging our business based on that discontinued operations performance. So we include the income or loss from the operating segment prior to their disposal and the gain or loss on the disposal of the segment. So if we sold it to someone else at either a gain or loss, we would need to report that. We would also show any income taxes related to that separately from our normal income tax expense on the income statement. We have this example where we have revenue of $480,000 and expense of $430,000. During the year, we sold a division of the company that had revenue of $100,000 and expenses of $750,000 or $75,000. Those numbers are not included in the above amounts. The division was sold at a loss of $55,000 and we have a 40% tax rate. So we're asked to make an income statement for Wabash Incorporated for the year. So we're going to start as we would start every income statement, which is with revenues. We have regular revenues of $480,000. We have expenses of $430,000. That gives us income from continuing operations of $50,000. Then we have our operating income from discontinued operations So that operating income is $15,000. That's the difference between the $100,000 of revenue and the expenses of $75,000. Then we have loss on the sale of discontinued operations. Sorry, this is net of tax. That's where that other $10,000 went. So we have a $25,000 amount times our 40% tax rate, so a $10,000 income tax that we remove from that. So we had total operating income of $15,000, so past tax. Then we have our loss on sale. Our loss has a $22,000 income tax amount. That's our 40% of $55,000. So we have a total net income from the company of $32,000 after we take into account the loss on the sale of discontinued operations and the operating income from those discontinued operations. We also have unusual or infrequent gains or losses that can appear on our income statements. So these are things that don't normally occur often, do not occur in predictable patterns, and they can be a wide variety of examples. Some of the things that are included are if we lose money because we have a labor strike, any gains or losses on the sale of assets, losses from storms and natural disasters, and losses due to lawsuits. One of the important things to note about losses from storms and natural disasters is that it has to be an unusual or infrequent situation. So in Iowa, we have frequent floods. In the state of Iowa, flood damage is not considered unusual or infrequent. So it can't be things that just normally happen regularly from weather patterns. And we can say, oh, well, but we might go 5 years between a really bad flood, so that makes it infrequent. However, we know, because we live in Iowa, that flooding is not unusual. So it really depends on your area, and it has to be something that's completely out of the ordinary. In Florida, hurricanes would not be considered unusual or infrequent gains or losses for companies that are operating in Florida. When we show our unusual and or infrequent items, they aren't shown on a net of tax basis. So any income tax effect of these items gets combined with our normal income tax. So this is different from the discontinued operations where we show those net of tax. Our unusual and infrequent stuff is just included in our normal income tax expense amount. We have an example for Phillips Incorporated. They had income before income taxes of $275,000 from their normal recurring operations. They also had tornado damage on their company's warehouse. Tornado damage is extremely rare in their location, and we suffered a $100,000 loss. So because of this, if we were preparing an income statement for Phillips Company, we would have revenues of $275,000 and expenses for this loss of $100,000. Giving us an operating income before taxes of $175,000. With a 40% tax rate, our income tax expense is $70,000, giving us a net income of $105,000. Additionally, we have Hudson Company, so we have revenue and expenses. We have a gain of $115,000 that resulted from passage of new legislation. This is considered unusual and infrequent for financial reporting purposes, and our tax rate is 35%. So if we come into this, when we take our income minus our expenses, we have income of $750,000. We have expenses of $600,000. And then we have a gain, an infrequent gain of $115,000. This gives us income before taxes of $265,000. If we take $265,000 times 35%, we get an income tax expense of $92,750. We subtract that from our $265,000 and we get a net income of $172,250.